Okay, as you can see here, this is a conversation about participating with rising interest rates, and that's inside a fixed index annuity existing policy. So I'll explain what I mean by that. To give you a little context, we are in October of 2011, and the 10-year Treasury is below 2%. Okay, so I was at a conference, and people overheard some conversations where somebody said, okay, so if I put $100,000 into an index annuity, and let's say my internal interest rate is 1.2%, that's my interest rate, that's the credit that the insurance company gives my policyholder, and the caps, let's say the caps are 3.5% on an annual point-to-point. So the conversation was that okay, I'm not happy with this interest rate or this cap level in today's environment. However, if interest rates go up, then that's okay. My client will be able to participate. And you know what? That's just not true, right? And so we need to understand why and go through that. Okay, so let's just assume, let's fast forward, let's just pretend that in 2012 that the 10-year Treasury is up to let's call it 3.5%. Okay, let's just pick a number. All right, and a new policy, a new $100,000 goes into an FIA. Their interest rate, their internal interest rate, could be up at let's call it 2.5%, and their cap could be at 4.5%, right? So this could be the interest rate, and this could be the cap. That's all true. New money will participate in that, but this existing money, it won't necessarily do that, and there's some dynamics we need to understand why that is. So let's say this $100,000, right? This year, right? Let's say they put it in October 2011. The insurance company, here's the $100,000, and the insurance company also sold a bunch of 50s and 20s and 200,000s and millions. You have all these different policies within a week's period of time. So over a week's period of time, they collect, let's just call it, they collect $10 million in premium. Okay, and it's all through a 7-year product. They're going to take this $10 million and they're going to go out and they're going to buy duration matching bonds, meaning they're going to buy 7-year-ish bonds, and they're going to be buying A plus, and they're going to be buying A, and they're going to be buying A minus, and they're going to be all over the place, and they're going to, in order to get a blend, and let's say that their blend, they're able to get an overall bond yield of 3.2% for a bond portfolio. And we talked about earlier that the average expense spread for an insurance company is 2%. So this is an expense spread to run the insurance company, turn the lights on, pay the rent, pay commissions, and all that, right? So if their bond portfolio is making 3.2 and the expense spread is 2, then they're going to be 120, and there you go, there's that 120 up here. So this is the interest credited inside the policy. This is what the shareholder gets each and every year. Okay, now on a fixed index annuity, they get a choice what they want to do with this. They can either every year they can just let it accumulate inside the policy, or they can take some or all of it and buy an option to participate in the market, right? And so that's 120. Now let's say that this first year, remember this is October, so this is 10/2011. They put this money in, they get the 1.2, and then this exact same policy, it is now October 2012. It's on the anniversary date, and the 10-year Treasury has gone up to 3.5. Well, this money, they're still going to get the 1.2% credited in there. Why? Because this paper's already bought. They're not going to sell this stuff and then go out and buy a bunch of new paper at a higher interest rate. It doesn't work that way. They're stuck. They're going to get all that. And so if interest rates go up, an existing policyholder isn't going to get a higher interest rate internally because the bonds are already matched, number one. Now let's talk about the cap for a second. There are two variables on a cap, two main variables, right? It's the interest rates, which determines how much money that you're going to give the option trader, right? So you've got the guy, you've got this option trader waving his arms on the option floor, right? Waving the arms and screaming and shouting and doing all the stuff that we always see option traders do. And if you give him money for the S&P to buy an option, the more money you give him, the more of the option you're going to be able to buy. The less money you give him, the less of this option you're going to be able to buy. So that's going to determine what your cap is, or what your participation rate is, or what your spread is, right? All that's going to determine. The second factor, so this is one, the second factor is what? Volatility, the VIX. How much is the S&P option bouncing around? The more volatile, the less premium you're going to get, the lower the cap is going to be. Why? Because it's less predictable. He doesn't know what the heck's going to happen. The more narrow the VIX band in here, right, the more narrow it is, it's more predictable, and he will give you a better option price. Okay, so let's bring this back over to our existing policyholder here. We know that the cap is 3.5%. When this person invested, it was determined 3.5 off of two factors: what interest rates were, which is tied in here, what interest rates were, and then with the VIX. Well, it just so happens that in October 2011, the VIX is very volatile, so that's why this cap is so low. Now, in 2012, we know that one thing could be affected and the other will not. Of these two factors, are we going to be able to bring more money to the broker? The answer is no, because the 1.2 is fixed. Why? Because we went out and we bought duration matching paper. The second factor, the volatility, could be affected, meaning if we go through in 2012 and the VIX has become less volatile, in other words, it's smoother, then this cap actually could go up. This cap could go up simply because the VIX has calmed down. Not because we gave the broker more money, because interest rates haven't changed inside the policy, but the VIX could calm down and the annual cap could go up. All right. So let me just let's talk about for a second if the volatility gets even worse. So let's look at that scenario. There have been situations where an insurance company actually reduced caps within the product. And there's a lot of reasons why they did that. One thing we know for sure is it irritates everybody. But as you look at here, the option pricing factors are interest rate, how much money do we give to the option broker, and then secondly the VIX. If the volatility index actually goes higher after somebody puts money in, that could drive down the cap within the product, right? So you have these situations where once you go inside the product, your renewal rate, and there's really two rates you're talking about, you're interested in. There's your interest rate, which shouldn't change. Why shouldn't it change? Well, because if they bought duration matching paper, like we talked about over here, if they bought duration matching paper, the paper's fixed, so it shouldn't change. And then the second thing on the renewal rates is the caps. Well, if the caps go up, that's great. And if they went up because the VIX went down. It became less volatile. Okay, that's a horrible little arrow. Let me just fix that so it's clearer. So the VIX went down, it was less volatile, so the option broker gave us better pricing. If the caps go down, which nobody wants, then that meant the VIX, the volatility, actually got worse. It became more volatile, which the broker over here gave us less participation in the index. Okay, so that's why you see some products have a bailout feature, which means, let's say for instance that the cap they gave you is 3.5%, and they say in the contract that if we ever go 1% below the cap you were originally on your first anniversary, then you can take your money out. Okay, so that meant if they renew the next year, let's say the index volatility here, that could drive down the caps. And then, so what some bailout features, meaning if they breach this more than 1%, meaning if they came out and they said that the caps are, instead of 3.5, the cap is going to renew that next year at 2.2, well, that's more than the 1%, and you can get your money out. Okay, you can get your money out. So that's the situation where the cap could actually move around. So long and short, existing policies, meaning once your money is invested, existing policies, their interest rate should remain the same. The caps can go up or down depending on the VIX, and the VIX only, not because we're going to any kind of interest credit change. And if you want to, as we started off here, if you want to participate in rising interest rates within a fixed index annuity, you're going to have to do it with new money. Okay, hopefully this helps clear some stuff up, because I think it's important that we only sell this the correct way, and we don't set an expectation that isn't realistic. Okay, thanks for your time.